Hello traders. So the markets were quick to recoup their losses after Donald Trump announced those extended tariffs yesterday. Investors are presumably expecting more deals to be done before the August 1st deadline now. After all, Trump himself said that the levies are not 100% firm, and because of that we've seen equity indices bounce back. Euro-dollar has started to ease lower now, with the dollar finding support against most currencies, although the Australian dollar obviously rebounded overnight because of the unexpected rate hold by the RBA. Now, looking at the equity indices, as you can see on this watch list, all the major indices are in the positive territory at the moment. The S&P 500 has found support from around 6,210 area, which was previously support. It has recently hit a record high, so the path of these resistances obviously to the upside, and this could well be the resumption of that bullish trend. The key area of support for me is the shaded region now, which was the previous high hit in February and prior to that in December of last year. And this shaded region acted as resistance for a few months before we saw that big drop earlier this year, before we went on to break above it at the end of June. So this area remains exposed for a potential retest from above, which could happen, for example, if the trade war intensifies. But for the time being, the trend remains bullish with shallow dips, and traders are happy to step in on any pullback. Now, looking at a few other major indices, you will see a similar picture. The DAX here has broken out, hasn't it? It was consolidating before inside a continuation pattern, a triangle. And as you can see, today it has taken the resistance trend of that triangle out. Now, if the DAX can hold the breakout, then we could potentially see a fresh record high, which was hit in early June at around 24,490, this black line here. And above that, there's not much resistance, obviously, because we're trading at record highs. But do watch out for some profit taking around the 127.2% Fibonacci extension level shown on the chart. And then above that, the 25,000 psychologically important level next. Now, looking at the FX markets, the dollar is coming back, and as a result, we've seen the euro-dollar turn lower, having been higher earlier in the session. The euro-dollar has found resistance from around 17.50, which was previously support as I zoom in. This level gave way yesterday, and we closed lower. It was retested earlier this morning from underneath, and that level has turned into resistance. So it looks like the euro-dollar could be in for a bit of a correction, at least, with key support coming in this shaded blue area where we have the bullish trend line that has been intact since the turn of the year. That converges with the 21-day exponential moving average, as well as previous resistance levels that were made in April and again in June, these levels here. So all of that is coming in at around 115.70-ish to 116.30-ish. This zone is shaded in blue on the chart. So if and when the euro-dollar were to go below that area, as things stand, that would be a bearish technical development. Now, looking at the weekly chart, the euro-dollar is clearly at overbought levels in terms of the RSI, the relative strength index here shown in purple. You can see that the euro-dollar recently created a new multi-month high, and that caused the RSI to rise above the 70 level, which is the threshold for being overbought. And as you can see on previous occasions, whenever the euro-dollar neared or rose above 70, invariably some correction or consolidation followed it. So could we see a similar picture this time around? Well, that's my base case scenario, that we will see some consolidation at least, and potentially a decent pullback as well if the dollar bullish story gathers momentum. Now, it's worth pointing out that the dollar has already started to turn positive against some of the major currencies like the Japanese yen, for example. So it could be ending its bearish trend, or at least pausing for the time being, as the focus shifts to the macro picture, which points to elevated inflation in the US in the coming months, which probably calls for a firmer US dollar. For more market updates and analysis, make sure to check out the news and analysis section at cityindex.com. See you in the next video. Take care.